Hello, everyone, and welcome to the webinar today. My name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. And I'm so glad that we could have you with us today. We are going to be talking about a very time-sensitive issue about technology investments that the government will pay you to make with tax season just around the corner. You definitely want to listen in to this whole thing. We have two fantastic experts with us that will guide us through some of these really interesting tax incentives that you may not even know about. So very excited for that. But before we begin, I just want to cover a couple of things. One is we are recording this, so if you do miss anything, don't worry. We will be sending out the recording tomorrow for everyone to review, as well as the PowerPoint, so you can follow along and take notes after. And we'll also send you the contact information of the speakers. We will have the time at the end for questions and answers, so please enter your questions in the question box if you can. We appreciate it having the questions there, not in the chat. It is much easier for us to track questions in the question box, but if you do put it in the chat, we'll take a look there too. So please put your questions at the question box, and we will also take questions potentially during the webinar if they do apply to the topic we're talking about. Otherwise, they will be saved for the end. We're looking at roughly an hour here with some presentations, some discussion between Tom Wheelwright and Himanshu Caplash, our two speakers today. I'll let Himanshu introduce himself and I'll step away while he gets started with the whole presentation. I hope you all enjoy. Thank you, Himanshu, for coming on and speaking to the group.
Awesome. Thank you, Alexandra. And thanks everyone for joining. As Alexandra said, it's a topic which is top of mind for all of us. Tax season is around, so the topic is very timely. We presented here a couple of months back talking about technology which can be implemented for smaller multifamily and bigger multifamily apartments. So the question of, hey, how can we get tax deduction if we do this technology investments came up a lot. So here we are, talking about that. So just a bit about me. I'm a senior product manager at a company called LiftMaster. You may know us as, garage door open company, but we do have a lot of other products which are very specific to multifamily, all the way from 2 units to like 100-unit apartment buildings and garden style properties. I have been in the technology industry for 12 plus years. I have worked across small companies, big companies, thinking a lot about property management and how through technology we can make the life of people who are living in there and life of people who are managing those properties like a little bit easier. Today, I'm joined by Tom Wheelwright, who's a CPA and a CEO of a company called WealthAbility. He's also an author of an awesome book called Tax-Free Wealth. So welcome, Tom, and I'll let you introduce yourself as well.
Yeah, thank you. Thanks so much, Himanshu. Thank you, everybody, for being with us. So I'm curious, if you would, in the chat, if you don't like paying tax and you would like to reduce your tax, put no tax in the chat. Go ahead and put no tax in the chat. And there we go. There we go. We got the first. If you don't, Hussein, Maria, Eugene, Fred, no tax, Patricia. All right, no tax. I love it. I love it. I love it. So Tax-Free Wealth is the book that is I've been very fortunate. It's been the #1 bestseller in its category for many, many years. And I just wrote a new book called The Win-Win Wealth Strategy, 7 Investments the Government Will Pay You to Make. And interestingly, technology, Himanshu's specialty, is chapter 3 of that book. So we spent an entire chapter on the tax benefits of technology. Gabriella, I love it. No tax. That is awesome. Okay, that's what I like to see. I've actually never met, I've spoken all over the world. I do a lot of speaking. Some of you are probably familiar with the book, Rich Dad, Poor Dad, which is the best-selling financial literacy book of all time. And Robert Kiyosaki and I are good friends. I was just with him at his seminar last week, and I am his CPA, and he's allows me to say that. on film. Otherwise, I would not be able to do that. And he's just changed so many people's lives. He asked me to write Tax-Free Wealth just because when I travel, what we find is that nobody likes paying more tax than they have to. You know, I mean, people will say, well, you know, the rich should pay more tax. Well, it's really easy to point your finger at somebody else and say, we don't like the incentives that the other people have, but we love the incentives we have. Well, the reality is that the incentives are there for good reason. And the incentives in both the nice thing about what we're talking about today is we're talking about business, because real estate is a business. Real estate investing is a business. So we have all the business tax benefits. That's chapter 2 in my book. We're talking about technology, which is chapter 3 in my book. And we're talking about real estate, which is chapter 4. So we actually have 3 different incentives, major class categories of incentives the government wants us to take advantage of, because then we have more capital to do things that the government wants done. And as long as we invest in these areas, the government says, look, we'll help you pay for that, because we will down the road get a return on our investment. So they're just investors with us. We are partners with the government, and we don't, it is what it is. You don't get to choose whether you're a partner with the government, but you do get to choose what kind of partner you are. So I'm very excited to be here with Himanshu, with LiftMaster. I appreciate them sponsoring this event, because I do think that a lot of this is not known. That look, if we could get, you know, if you go to a store and there's a 15%, I mean, Geico's the best known for this, right? Give us 15 minutes of your time, we'll give you a 15% discount. But what if you can get a 30 or 40% discount? And that's what we're going to talk about today. So Himanshu, it's back to you.
No, I love it, Tom. Like, especially your mental model on like the government is a partner. We just need to understand a little bit more about the tax laws. And I think that's where experts like you can help me and like, you know, this audience in understanding how we can take these investments, create value, but also get like tax reduction. So yeah, that's exactly the topic for today. So I think just so that everyone is aware, we want like maximum value to deliver here. So we will be using a bunch of conversations as well as slides. So get ready to take notes. As Alexandra said, there will be a recording, so you can always refer back to that as well. But let's jump right in. So Tom, let's talk about your first wealth creation strategy, which is net operating income, NOI. So let's talk about what is NOI and why it is very important for property investors.
Perfect. So this is really simple. This is, if you were a cash investor, what would be your return? What would be your cash flow? That's what net operating income is. So it's income, rental income, minus all of your expenses, except for your financing expenses. Now, that's important for 2 reasons. The first is it's important because, of course, why would you invest in real estate if it's not producing cash flow? But the second is that it actually determines the value of your property. So if you look at how do you value a rental property, it's simply by your net operating income divided by your cap rate or your capitalization rate. So if your cap rate is 10% and your net operating income is $10,000, then that means that the value of that property in the rental business is $100,000. It's really simple. If your cap rate goes down to 5%, you just doubled the value of your property. But also, if your net operating income goes up, let's say your net operating income goes from 10,000 to 20,000, not only do you get more cash flow, you've doubled the value of your property because of that simple formula. So it's that cap rate formula. It's net operating income divided by cap rate is the value to an outside investor of your property. We can't always control the cap rate, although some of the things Himanshu is going to talk about today, I think do improve, actually lower the cap rate, because they can turn it from a class B minus to a class B, or a class B plus to a class A minus building. And when you do that, anytime you move upwards in that strata of type of class of building, you immediately reduce your cap rate. So what Himanshu is talking about both reduces your cap rate, gives you a tax benefit, and increases your value, besides increasing your cash flow.
Yeah. I mean, I I think it sounds like NOI is a very important metric for like all the property investors to like keep a track of and always be thinking about how can I increase my NOI, right? Because it's, to your point, it's affecting the property value as well. It's affecting, how much taxes you pay and like the cash flow that is coming in as well. So I think to your point, we from like the technology or property technology industry side as well, we have been thinking about some of these things as well. So I think there are a couple of things which are happening on the technology space, right? So we are both helping to increase the revenue for multifamilies by providing like more value for residents. And there are also solutions that are helping reduce the expenses, right? By streamlining the operations, etc. So I think the way at least I look at the property technology industry, there are like three big categories, right? So the category number one is enhancing the resident experience. So this is where property investors and property managers, by introducing technologies like smart thermostats, internet connected appliances, smart lock, right? So all the innovation which is happening in smart home to increase the resident experience, which then turns into people paying more rent, people staying longer, and then people being generally happy with the property and not like moving sooner, right? So that's kind of one big category where technology can help with NOI. The second big category is streamlining the property operation. So this goes back to what Tom was talking about, like the cost side. So, rent collection, maintenance tracking, resident communication, leasing, how can you streamline all of those things and do it in a much more efficient and like cheaper way? So there are many software solutions which are available in the market to help property managers, especially multifamily property managers, to do the job. And I think the third category here is modernizing the property entrance, right? So this is a topic which is very dear to me and our company LiftMaster, because we have been thinking about all the problems that can happen on a property entrance, and then how do you solve some of those challenges. So let me go a little bit deeper and like connecting back to what Tom was saying about NOI, right? So one of the NOI is how do you kind of increase the value that you're providing to the renters. So there was a recent survey where Gen Y millennials, which are most of the newer renters, in the last couple of years, is this demographic. They feel like 20% of Gen Ys feel or reportedly have felt like unsafe around their communities and the properties, which is, a problem for all of us in the industry, but also like in the multifamily space for the operators. And then, 55% of Gen buyers are likely to pay higher if, some of these smart access technologies like door locks are available because they feel more safe. And that's a technology they have been used to, right? So I have an iPhone in my hand right now, like where all the financial transactions happen. Why can't like we just use that to for properties as well? So just going a little bit deeper on the on this side of the things on property entrance, another factor along with like residents requiring the modern use of property entrance is the rise of online services, right? So this is all your food deliveries like Uber Eats and DoorDash, all the e-commerce and package deliveries, right? So just the amount of packages that get delivered to some of the multifamily properties, just being outside of the building sometimes, which is not safe, is increasing a lot, right? And then other maintenance services like plumber or your HVAC provider. In the good old days, you would know one plumber and that's the plumber you would use, right? But now we are using online services to find the cheapest service available. But that means an unknown person would want to enter your property now, right? So how do you think about kind of modernizing that? Is how we have been thinking about it. And then short-term rentals, right? A lot of properties do put their properties on Airbnb, on Vrbo, so that's one challenge as well. And we have talked to property managers on this side as well, right? And they have unique challenges. We have heard from you that you want to manage all the common access points through a single dashboard. You want to proactively allow guests and maintenance access in a very seamless way, right? You do not want to travel all the way to the property and kind of handhold using keys to them. Like, how do you do that automatically? And then if some incident happens, how do you identify and document those culprits, which can also help you reduce overall cost? Going back and connecting to the concept of NOI, that is how it will help as well. So we will be talking a little bit more about like access control specifically as well. But let's go deep dive into like the second wealth creation strategy and listen from Tom. So Tom, if you could talk about just the depreciation for tax reduction as it applies to like properties, if you could talk about that topic in general, I think that will be helpful.
Yeah, of course. Just one little thing about what you've been talking about, though. I mean, I can think of all these ways that you're increasing the value of the property, because if you get a higher quality renter with the technology, it would seem to me you would get a higher quality renter, because the Class C properties, they're just trying to find a place to live. They don't have expectations. But a Class A property, they absolutely expect this stuff. I mean, it is expected. And so if you had a Class B property, which is most properties, and you put some technology like this on it, I mean, all of a sudden you've distinguished yourself from all those other places that just have a deadbolt and a door lock, right? So now all of a sudden you've got some serious upgrade for not very much price. And when I noticed your slide where it said that 55% would pay more. Well, okay, so and that 55%, by the way, I'm sure is Class B and Class C, right? The 45% is low. I mean, Class B and Class A. The 45% is probably in Class C and B minus type properties to begin with. And so if they're going to pay more, remember, as your net operating income goes up, if you can increase your net operating income, your rent by $25 a door, $50 a door a month, then that increases your value. It skyrockets your value because you've got a multiplier effect on that. Okay. Now, the next thing to do to multiply your value is to look at what are the primary incentives that the government gives. And the first one is what we call depreciation. So if you go to the next slide. So basically, when you buy a property, you really are buying 4 different types of assets. You buy the land, which doesn't wear out, so no tax deduction for that. You're buying the landscaping, which and all of that what we call land improvements, which includes your outdoor lighting, your fencing, your covered parking, stuff like that. You're buying the building, and then you're buying the building contents. Well, how they're taxed is very different one from the other. So the tax on the deduction for the building, remember, buildings, the government says that a residential building will wear out over 27 and a half years. So that's about 3.6% per year of a deduction. Well, that's great. We love to get 3.6%. But the landscaping, the outdoor, the land improvements, and the building contents, this year, 80% is deducted immediately. 80% deducted immediately, called bonus depreciation. So last year, 80%, next year, it goes down to 60%, but it's a huge tax benefit for landscaping and building contents. The rest of it is deduct over anywhere from 5 to 15 years, that other 20%. So these are enormous tax benefits, so big, in fact, that I've run these numbers many times. And in many cases, the tax benefits, if you do this right, you have to do a cost segregation, but the tax benefits are so great. From real estate, the government is essentially paying for 50% of the down payment. So if it's a $100,000 down payment, you're only putting down 50, which means you can really buy twice as much property, which is really what we're looking at. So this is just basic tax 101, but a lot of, I'm just shocked, Himanshu, about how few multifamily owners actually understand the magic of depreciation.
Yeah. And I like your mental model on thinking about, hey, you're not just buying your property. If you divide it up, it's land, it's landscaping, and the way you should think about tax deduction and depreciation is very different for each of these categories. And then, in understanding those is how you get the maximum value for tax reduction. So you're spot on there. You also mentioned something about cost segregation. Do you want to just provide a little bit more detail?
So real quick, all you're doing is you're hiring an engineer and an accountant. The IRS requires both. And they're going in and they're allocating the cost between these four types of assets, but they're doing it scientifically. Okay. So there's both an art and a science to it, but you have to have both the engineer and the accountant to figure out, okay, how much of that cost of that property, if you paid $10 million for a multifamily property, how much of that was land, how much of that was landscaping, how much of that is, or out land improvements, how much of that is the building, and how much of that is the contents of the building. So you really have to do that. And here's the nice thing. If let's say you own the property for 3 or 4 years, you can do that now and catch up on the depreciation. You're not going to get the bonus, which is the 80%, but you will get the 5-year, 15-year. You get that catch up, and that can be I've seen it completely wipe out. I had a client that literally had a $2 million tax bill, and the next year had a 0 tax bill because we did cost segregations. So it's not, it shouldn't work that way, because you should be doing it every year and every time you buy a property, but it can just have an enormous effect, even if you do it late.
Yeah, no, that's awesome. So it's, what you're talking applies not only for people paying attention now, but like, hey, I missed something a couple of years back. So there is still, an opportunity to look at that and make sure, we still can get all those values for our property. So that's good. So now let's talk about one of those expenses, which is technology investment, right? Because that's the theme of the day today. But before that, do you want to talk a little bit about Section 179? Because I think this came up.
I do, because there's a little misnomer here. People think, okay, that's depreciation. It's not. It's instead of depreciation. And it doesn't apply to contents of a building. It doesn't apply to the land improvements. What it applies is to equipment. Okay. So it just applies to the equipment. Okay. Well, so that's what Himanshu is talking about, is equipment. And so this is this is instead of depreciation. So you can take 80% bonus, or 179 allows you to deduct the entire amount of equipment that you're purchasing for your business in the year you purchase it. So it's actually, as bonus depreciation starts, like up till this year, we didn't take 179. The last 5 years, we've never taken 179. But now that we have bonus depreciation phasing out, we're going to start seeing more and more Section 179, and particularly where you're adding equipment to your property, like Himanshu is talking about.
Okay, that makes sense. So yeah, now what we can do then is look at one of those equipments as an example. So smart video intercoms from LiftMaster, which is the company I represent. I think this kind of so what Tom is talking about, this falls right in there, and it connects back to the previous slides I was talking about, just the importance of modernizing your property entrance, right? So what we provide is a smart video intercom. It's an intercom that controls the door of your property, right? So you can remotely switch it on and off using your app, using your Apple Watch, or using your web. So there are multiple ways through which you can just remotely manage the entrance. And it has a camera, right? So the camera allows you to have a video call with the guest who is at the entrance and make sure that plumber that you hired from some online service, before you let them in the property, you can verify it is actually that and no one is tailgating them, for example, right? So there is a lot of value there. For residents also, there is a lot of value that we provide something called guest passes. So this is just that any resident can provide one time or for a specific amount of time, a guest pass that people can use and just enter the property. So, hey, my grandmother is visiting me. She can have a guest pass. She doesn't have to call me, or I don't have to manage keys with her, and all those things that can happen. Or maybe there is like a cleaner, right? So there is a cleaner that comes in every Wednesday from 12 to 1, for example, and comes to my property. I can now automate all those things seamlessly using, the smart video intercom that we provide. So that's all the value on for the residents and like also the property managers. But property managers do get a lot more value, right? So through the web portal, you can review who accessed the property and at what time, with video clips of the action which was happening at that time. So we have gotten feedback that this access event log feature is very helpful for property managers. In case an incident happens, they can go back and see, okay, what was happening, who entered, etc. Right? So it helps property managers to triage effectively. And all that is available for up to 30 days. So you can always go back, day number 25, what happened, I can always see the value there. So that's a smart video intercom. There is another solution, which is a smart reader. And this is now replacing your keys, right? So another insight which came from our research as we were building this product was physical keys is a big pain for property managers, right? Because, hey, the resident lost their key, you now have to provide a duplicate key. They are calling you 10 p.m. in the night and then saying, hey, I'm stuck out, like, how will you get me in? So a smart reader can get rid of all those things by replacing the physical key with a mobile credential, right? So just like how I use Apple Pay to now pay at a grocery store, I can use my phone to very securely. And by the way, like mobile credential can be more secure than a physical key because it cannot be duplicated. And I can securely enter the building. And all the other features of remote unlock, guest passes, all of that still apply for with a smart reader as well. So yeah, I mean, just wanted to highlight some of the things that we at LiftMaster have been working on. And then, connecting to what Tom was saying about that there are all these investments that you can take tax advantage of, right? So I think if I hear Tom, you say correctly, people can depreciate all of it, if not all, like 80 or 70% of the investment they are making in these kind of solutions.
Yeah, a minimum of 80%. Yep.
Yeah. Okay, cool. That's good to know and for everyone to understand. So one thing to consider there is that there is a software and a hardware component to this, right? So there is a one-time investment, which is, hey, I bought an intercom or a smart reader, but there is also recurring software fee for people to make video calls, for property managers to review the access logs. Could you talk about like the depreciation versus operating expense, how people should think about it?
Yeah, so they're they actually have different consequences for you. One is, so depreciation is good from the standpoint that your banker will add back in depreciation to come up with your cash flow. They will not add back in an operating expense. So from a banker standpoint, it's actually better for you to be depreciating. From a pure tax standpoint, an operating expense is always better. Why is that? Well, because depreciation, if let's say you only own the building for 2 or 3 years, we've had a lot of that in the last couple of years. You only own the building for 2 or 3 years, you can actually have to recapture depreciation, but you never have to recapture an operating expense. So now I'm going to tell you one more little trick that's not in the slides. So you're going to have to listen carefully to this. And if you don't catch it, you want to listen to this again, watch this again. And that is that any line item that is under $2,500 is considered an operating expense, not a capital asset for tax purposes. So that means that if your card reader is $900 or $1,500 and you buy 50 of them, that's 100% deductible as an operating expense. You don't actually have to depreciate it. You can just list it as a supply. Anything under $2,500 line item. So a lot of what Himanshu is talking about, we won't look at depreciation or 179. We're going to actually pick it up as an operating expense, treat it as either a repair, or we're going to treat it as a supply. And therefore we get to deduct it immediately with no possibility of recapture. What does that mean? Well, what it means is when you sell your property, even if it's only in 2 to 3 years, then you end up with capital gain treatment, meaning that instead of being taxed at your regular tax rate, you're taxed at your capital gains rate, which is routinely half or less than half of your regular tax rate. So operating expense from a tax standpoint is way better than depreciation. And depreciation, by the way, is better than 179. So the recapture is such that operating expense is better. But again, when you're talking about small individual components here, frequently we can take them all as an operating expense. And software, of course, we can always, as a general rule, we can take as an operating expense anyway, but also it's probably less than $2,500. So we're probably okay there too.
Okay, awesome. Yeah, thanks for walking through it, because this is one thing we hear constantly from our customers is that we love your technology. We understand, how important it is for us to upgrade, but I don't have the budget, or how should I think about expenses? So I think you helping us clear that there are these tax incentives there.
So let's talk about this. Okay.
Yeah.
So a typical property owner is going to be in about a 30 to 33% tax rate. Okay. Some of them are in 37, but I would say typical is probably 30. Let's say it's 30%. Well, that means that the government's giving you a 30% deduction or 30% discount. So if something costs you $100 from the provider, say Himanshu sells you a piece of equipment for $100, guess what? You're really only paying 70 because the government's paying the other 30. So wouldn't you like that kind of a discount on what you're buying? So never think about it. When you're buying it for rental property, don't think about, it's not the retail price that is important. What's important is, what are you actually net paying? Okay. And so Brandon asked a really important question here. The $2,500 line item for capital expenditures, that's actually per item. So in other words, it's not annual, monthly, or anything. It's not a time frame. It is a per item. So per line item. So you could buy literally 1,000 things during the year that were under $2,500 and you'd get to deduct all of them. So I think that's a very important point that you bring up, Brandon.
Yeah. Yeah. So let's at this point bring in some, audience poll as well. So Alexandra, we may be jumping through like the sequence here, but there's a question around what's the biggest. Yeah. So let's do this first. How do you manage access to your property today? So if people can help us understand, today, if you look at your properties, how are they managed today? That'll be very helpful for us. I'll give another like 30 seconds for people to respond.
Yeah, I'll give it a little bit of time here to get some good data. This is interesting. I'll share it in just a moment. We're at the 30-second mark. All right, guys, I'm going to go ahead and share the results here that we have so far. All right. So I think you can see those results.
Yeah. Yeah, I can see. And it's not surprising that, regular keys are still very common, but I'm hoping, one of the takeaway from this discussion is people that think about, how they can modernize their access control with, smart access control, providing, all the value there. So so this was insightful. Let's do another poll questions while we are at it. Yeah, so this one was around how long you have been investing in multifamily housing.
Yeah, we've asked this question before. It's always great to see we have people of all different experience levels joining these webinars. I love those of you who are marking 10 plus years. You guys are still learning. That's what real estate is. You're constantly learning. So please keep coming. And those that are less than a year, you definitely need to be coming to these. We have a lot of great information for you to share. Yeah. Gabriella asking, you mean owned? Yeah. So if you mean owning investing, it's kind of interchangeable here in this case. So I'll go ahead and share the poll results here.
Oh, nice. There's a good split here, but then most of the folks here have been doing this for 10 plus years, which is incredible. So Tom, from your experience, and I know you have been on this mission to educate people about like taxes and how they can save money. Like from your experience, what's your typical like customer base? Like are people in this business for a long time and they're still learning new things? Like
we work with people everywhere, from people who are just getting started to people who've been professional real estate investors for 20, 30 years. So I have clients that they're big operators, right? They have 10,000 doors, something like that. And then we have other clients that are literally just getting started. So, here's what's really interesting though, Himanshu. How long you've been in real estate does not necessarily determine whether you're doing it the way you can do it and taking advantage of everything. And I think that sometimes people get lulled to sleep by their tax preparer, their tax advisor, or I've actually had people say, well, cost segregation, that's aggressive. I'm going, by the way, just for all of you, if you haven't heard this before, under the law, cost segregation is required. Now, the IRS doesn't enforce that, but under the law, it's required. So if you ever have somebody tell you it's aggressive, say, well, wait a minute. If that's true, why is when I do a cost segregation, is that a change from an unacceptable to an acceptable method of accounting? That's what it is. So it's actually required under the law. So I just want to make that clear. And Byron followed up with his question with any provider fee. So fees generally are deductible services unless it's a capital, like construction fee. Okay. But like your normal subscription fees, if you've got a subscription, for example, for the software, and it's a software subscription, generally speaking, a subscription is going to be deductible. But we're talking about actually physical equipment, which normally you have to capitalize and put on your balance sheet. And if it's under $2,500 per line item, it's immediately deductible.
Yep, that's good to know. While we're on it, so Alexandra, can we do one more question? I know we had this question on what are the biggest challenges that this audience faces on their business. I think it'll be a good to get a sense of that as well.
Yeah, I'm always curious about this as well. It's certainly with inflation, rising costs, I've seen come up quite a bit. But also maximizing revenue. Rent is fluctuating depending on what rental market you're in. I know that's certainly a concern for some of our investors, for sure. Let's give it a few more moments. Go ahead.
One I'd like to see sometime, Alexandra, on here is interest rates. We can put that under rising costs. If you want to put that in rising costs, interest rates. I would like to know in the chat if interest rates are threatening or a very big deal for you right now. I mean, if you have a long-term loan, they're not. But if you have short-term loans, which 87% of multifamily loans over the last 5 years have been, they've been adjustable rate mortgages. And I'm seeing a lot of capital calls. I'm sure you are too, Alexandra. But I am curious how big, if you put that in the chat, are interest rates a problem for you?
Yeah, and I think it could flow into growing your portfolio as well. Obviously, the interest rates could prevent that. So, yeah. So here are the results we have.
Rising costs. Yeah.
Yeah. Makes sense.
Yeah, totally makes sense. Yeah. And this falls into the interest rate, but in general, like labor cost and whatnot, right? So again, like as you're thinking about technology investments, I was talking about how you can use some of the technology to offset some of the labor costs, for example, and do things more efficiently. So that's another.
So let me just share one thing with everybody here, because when we analyze our financial statements, it's important to recognize what's the purpose of an asset. And the purpose of an asset is to either increase income or decrease in expense. Either increase income or decrease in expense. So either one of those, because remember, if you're increasing income, the whole goal of income, get into cash flow. If you're decreasing expense, it gets to cash flow. Well, it also gets to net operating income, raises your value. So again, that's the purpose of an asset. And of course, and again, remember that the purpose of a liability is to buy an asset. So Sometimes, if you've got a good asset that's increasing income, reducing expense, then, borrowing to buy that is not such a bad idea.
Awesome. Yeah, that was a great mental model to think about. So let's keep going here. So I think one of the things we wanted to touch base on was just the ROI of the property improvement. Like, how should people think about ROI in terms of attracting and retaining renters? And I know you have like some formulas and some things for folks to consider in terms of occupancy rate. So it'll be helpful if you could like walk through.
Oh yeah. So my parents had rentals. They had duplexes that they turned into triplexes, which is a good way to increase, increase your renters by 50%. But they always made a point to charge a rent that was just below market. And the reason they did is because the most expensive cost you have is vacancy. In multifamily rental, your most expensive cost is vacancy. And here's why: because not only are you not collecting rent, but you have to turn that property. So you have to replace the carpet, you have to repaint, you have to get the smell out. Somebody who lives there, they're comfortable with their own smell. Okay. Even if it's a bad one, they're comfortable with it, but somebody new doesn't like that. And so there's actually that turn can be very expensive. So you really want to maximize your occupancy and keep them as long as possible. So I love this simple idea is just look at the occupied units, look at the vacant units, divide occupancy by vacancy, and then multiply that by 100. And that'll give you an idea of the increase in ROI, from an occupancy standpoint. But yeah. I just know from, I grew up with it. My parents, their triplexes were always full because that was the most important thing to them, was making sure the renters were there for a very long time.
Yeah. No, it's awesome you said that, because, if you think about convenience in the technology industry, people have been able to monetize convenience, right? So take Uber or Amazon. By providing convenience, you create stickiness, right? So the way for property investors to think about it is, if your residents are getting a good experience, which is convenient, it kind of fits into their lifestyle, they are more, the probability of them staying longer is better, because they just got to the habit of, or just deliver my pizza all the way through the property, I don't have to come down, for example, or at this property my packages are taken care of, I don't have to worry about it. So those small little conveniences create stickiness. So just for that to think about it, just a thought came to my mind that that's how most of the technology industry has been working on, like, how can we make things more convenient, and through that, like, increase the stickiness, right? Which translates to, for you, how do you increase technology investments that make the resident experience more convenient, which will increase to like more occupancy rate and less turnover there. Which again, like talking about Gen Y and Gen Z, again, we touched a little bit on that already. But people are willing to pay upwards of $31 as per the latest survey which was done, if they have all these convenient solutions available in them, right? Because this is the generation that has just grown up with smartphone, with web, right? So it's kind of an expectation for the renters of Gen Y, Gen Z, which are most of the renters, new renters coming in the market right now. And people are willing to pay more about it.
So a little math. It's always tough to do math, but little math here. So $30 a month, $360 a year. At a 5% cap rate, that increases the value of that one apartment by $7,200. So you're not comparing your $31 a month to what the cost is of the equipment. What you're comparing is what's the value, $7,200 compared to the cost of the equipment. So the cost of the equipment is a few $100s and it produces $7,200 of value. It's worth it. So what you're doing is you're using that. Remember, you're trying to increase your net operating income, and $30 a month, that's a lot.
Yeah. It's a good point. Okay, so let's keep going. I'll just go to kind of next steps, right? So next steps for how can you start introducing technology to your property? So I will go through that. And then Tom, after I talk about this, let's talk about next steps for people, right? Because the tax day is coming in few days. How should people think about it? So for me to first get started on introducing technology, I think I would recommend start small, right? Like change a thermostat, change your locks to a smart locks and smart access hub. Like just those small increments can start introducing this concept of convenience for your residents, which they not only pay more for it, but they will stay longer for. And then, you can just go from there. You can add keyless entry. We talked about smart readers that, make it convenient for people to use their watches and phones. So that would be next. And then you can go all the way to upgrade your complete smart system for your property, right? Like which is, the intercom we talked about. But at LiftMaster, we have, especially for access, a lot of products that we can talk to you if you're interested in, which can enhance not only the safety and security, but, again, coming back to that resident experience, it provides that as well. So that's kind of some next steps you can take on introducing technology. But I know, Tom, like the tax day is coming soon. So
It is next
how
week.
how do you want people to think about
Well,
like taxes?
Let me make a couple of comments. First of all, April 18th. It's not the 15th. It's not Monday. It's Tuesday this year. And that happens once every few years because of a holiday in Washington, D.C. For those of you in California, it's October 15th. So you have a long time. And in fact, those in California, you don't even have to pay your tax until October 15th. Now, I like extensions. And the reason I like extensions, if your bank is not pressing you to get your tax return done, and I get sometimes they do, but if your bank's not pressing you on that, you're better off for two reasons, I think, to file an extension. And you still have to pay the tax. One is you can get a better result with your tax preparer. It includes a cost segregation, including documentation. And your tax preparer isn't working until midnight, right? So they're not tired. The other thing is there's pretty good evidence, excuse me, that you're less likely, if you file in the summer, less likely to get audited. So we know with all these new auditors coming online, a lot of people are going to get audited. You'd like to be not be one of those. But remember, you do have to make your payments, even if you file an extension. And do not forget to file the extension, because if you forget to file the extension, a late filing penalty is 10 times as bad as a late payment penalty. So if you have to choose one or the other, file the extension. If you can't afford to pay the taxes, okay, it's 0.5% a month. That's a 6% interest rate per year. Not the worst thing in the world in today's interest rates. So know that, the penalty is way worse for not filing the extension than it is for not paying the tax.
Okay, awesome. Yeah, that sounds good. So at this point, let's do some Q&A. I know there were a bunch of questions coming up as well. So Alexandra, I don't know how we want to do it. If I'll be looking through questions, but if there are questions which are coming to the top, we can take them.
Yeah, I think Taro had a really great one about whether or not they could use this technology in an international Airbnb.
Yeah, so what I was talking about is connected to the cloud, right? So which means you can, control your property entrance from anywhere, literally, right? Because it's all connected to the internet. So you could be sitting in like Hawaii or like even like Europe, and your property is here in US or vice versa, and still kind of manage that. So if that was a question, cloud makes it easier for people to manage the property from anywhere.
Fantastic. Carrie also asking about commercial property and whether your systems can work with commercial instead of multifamily.
That's a good question. Yeah, so we do have a lot of commercial customers as well. And then, yeah, so the solution works for commercial if that's what's required. Again, like it's all about how do you control the entrance. So I talked about intercom, but for commercial, there are gated places, there can be garages, and LiftMaster has like a lot of solutions for commercial space specifically. So yeah, please feel free to reach out to me or our team, and we can help you there.
Great. Also have a question from Brandon, which maybe Tom can answer. Can you go into further detail on when or how a software subscription may qualify to be written off? I know we kind of covered it, but I think it might be worth mentioning again.
So if it's for your business, if it's for your property, it's going to be deductible as you pay it. I mean, it's a simple it's a simple expense. So nothing special on that. It's just like any other business expense. It's deductible when you pay it.
Great. Byron was asking about cost segregation as well, and when they would pay for the cost segregation study, would it be paid at the time of service?
Yeah. So first of all, let me tell you that cost segregation expert, and we have a number we refer to, they will give you an estimate of the savings and the cost before they do anything. So that's a real positive, right? You know what you're getting. Now, the investors, effectively, you need to build that into your investment amount, right? And for multifamily, it can be anywhere from $10 to $20 to even $25,000, depending on how many units you're talking about. That seems like a lot, but the tax savings can be in the hundreds of thousands of dollars. So from a proportionate point of view, it's a really low cost for a very high return. Don't let people sway you, and then tax advisors will tend to do this. Okay, they're wrong, but don't let them sway you that a cost segregation, if your investors are passive, does not produce any results for your investors. That is not true. Okay, first of all, cost segregation, your depreciation is an ordinary deduction, which is your highest rate. But when you sell it, your highest rate is 25%. So you've got a 12, let's say that you're in the highest bracket, you still got a 12% swing. So even if you don't get to take the deduction until you sell the property, you still have a 12% benefit. So that means, think about this. That means if your investor put in $100,000, it saves them $12,000 when you sell the property, if you did a cost segregation versus not doing a cost segregation. You really want to take that money out of your investors' pockets? The flip side is, why don't you tell your investors, here's the tax benefits, right? And let's, in fact, get your tax advisor to talk to your investors, put it in your prospectus, make sure that they know that, wow, there's some huge benefits here. The government is willing to be your partner, and we're going to make sure that you get all the tax benefits that you're entitled to as a government incentivized real estate investor.
Yeah, I still cannot believe people miss out on that, but thank you so much for emphasizing it, Tom. More people need to know it. Taro asking a question here for Himanshu. What size facilities can cost effectively use your technology?
So we have solutions that can work for a single family resident a property, or like 500 people living in like say a gated community. So we have solutions range like from, again, like very few family to a lot of family as well. So yeah, again, if you could reach out to us, we can see what exactly is your need, and then what solution might fit you there. But a short answer is like we support like the whole range of solutions, both like residential as well as for commercial.
Yeah, and I think really, starting a conversation would be the best next step to see what LiftMaster could do for you. Also, a question from Mr. or Mrs. Johnson here. In the age of cyber threats, how do you make sure your security is secure, and can cameras be installed throughout common areas?
Yeah, that's a very good question. So on cybersecurity, we do take a lot of precautions, and we use the latest, greatest research on like how cloud technology is built in making sure like we are protecting your residents, right? So that's on one side. And just talking, I think I talked briefly about mobile credential. That's why we are like so excited about mobile credentials. That's something we launched just a few weeks back, where like your phone is a much secure way of accessing than even your keys, right? So that's why people are starting to pay with their phones instead of their credit cards, right? So just to give that example. So yeah, cybersecurity is a big deal. And I think a company that stays top on making sure all the latest, greatest research happening there is incorporated into the products is very important. So you should think about that.
Yeah, absolutely. And I think, from a landlord perspective as well, reduction in liability is what I'm hearing. So having a more safe way to do it. I have actually read stories in the news of landlords who have been held liable for not switching locks fast enough in between tenants, or a tenant who does have a security issue like a restraining order, and they tell the landlord they need their keys or their locks changed. The landlord takes too long, something happens, and now the landlord is involved. So honestly, this is the fastest thing. With a click of a button, you could literally change the coding on this and securely make it so that no one else can access the unit except for the tenant. So, just my 2 cents there, and from what I see on my side. So another really great question here from Gabriella. Many of these companies charge per tenant. Is there a monthly charge with your company per tenant for access control and apartment entry?
Yes, we do. And the reason for that is that we have like a video subscription. So, people are actually calling. So if you think about it, it's almost like a phone. So most of the companies have that per tenant because that's how the cost is experienced on our side, right? So short answer, yes, we do. And, the reason is because you're getting video calling. So it's almost like a phone.
Okay. And also from Mr. T. Patel here, what options or design considerations should we plan for power or internet outages?
That's a very good question. So for an intercom, for example, you just need 3 things. You need power, you need internet, and you need some kind of a connection to the door, some kind of electronic door strike, which will control the door. So there are solutions available that can work even when there is a power outage. So our smart reader, for example, locally stored credentials, so that even if there is some kind of a power outage, they work. You have to think about that some of these doors are electronic, so you'll have to create a backup power for that as well. And we do have a lot of integrators, which are people actually installing our technology, which can help you spec out how to think about all these power internet outages and still use our solutions.
Yeah, and I want to say that's one of the advantages of working with a company as big as LiftMaster, is that they have those kind of connections and they can provide that kind of service really wherever you are. So definitely, it's not a do-it-yourself necessarily. They're there to help. Also, Hussein was asking if you can share your phone numbers and emails. Now, we do have the LinkedIn there, and Himanshu and Tom told me that we can certainly, you can directly message them on LinkedIn. Tom just dropped in his phone number and his email in the chat. So go to the chat and check that out so you can connect with Tom's team. I'll be sending you this info tomorrow in an email, as well as the recording and the PowerPoint slides in case you miss anything. So definitely there will be ways for you to connect. I love that you're already thinking that. Hussein says, thanks, Tom. And I think I missed a part of Mr. and Mrs. Johnson's question before about cameras being installed throughout common areas. So that is certainly, because it's a common area, something you could do, I believe. Does LiftMaster provide any service like that?
Yeah, so our solutions work not only at the entrance, but if you want to secure your pool, your package room, your common area where you have like parties and stuff like that. So, or even your like property manager area, all of that can be controlled. Because again, we had like short time, lot of topics to discuss. So I talked about intercom, but we have other solutions called a door controller, a smart door controller that can just make any door connect online, and you can do all the things I've talked about in a smart video intercom, but do it at any door of your property.
Great. And what about retrofitting certain properties? Is that something that can be done to install the equipment for like an older building?
Yeah, perfect. Yeah, I mean, so I would say most of our customers today are doing that in retrofit. Again, you need power, you need internet, and then you need an electronic door strike. Even for internet, we do have Wi-Fi enabled in our devices, which means you don't have actually to drive like an Ethernet connections or some kind of a port connection. So yeah, I mean, I would say most of our customers are retrofit, and this technology fits perfectly for the that segment.
Nice.
Great. Well, I mean, it seems like you have a solution for pretty much everyone on the call: old, new building, small, big building. So thank you so much for covering all of that. I don't see any more questions coming in through the chat or the Q&A, which is actually pretty perfect because we're right at our 60-minute mark. I kind of love it when that happens. You guys did a great job of presenting and answering questions. And Himanshu did put his email in the chat. So take a look real quick. I'm going to give you guys a second to save the chat if you want, because there's some good stuff in there. And I'll also be in touch with everyone tomorrow. We got some thank yous in the chat as well. I'm glad you guys all found this pretty useful. It's so great to have both of you back with us, and I hope to have you again in the future. Always good stuff. I really appreciate all the updates.
Yeah.
Thanks, Alexandra. This is
All
great.
right, everyone.
Thanks, Himanshu.
Take care. Have a wonderful day. Bye.
Bye.
Bye.